Question is that what is externalities? What is externalities? This is a topic included in the second sum PG public finance. That is, what is externalities? Externalities refers to when an activity undertaken by an individual or firm yields benefit to other individual or firms in addition to the benefit accruing to the emitting party. That is, when an activity undertaken by an individual or firm, that is, activity undertaken by individual or firm yields benefit or that is benefit to other individual or firms. That is, it yields benefit to other individual or firms in addition to the benefit accruing to the emitting party. That is known as externalities. That is, it refers to the activity undertaken by individual or firm. So it create or produce other benefit. It produce benefit or cost to others or third party. That's in addition to the benefit accruing to the emitting party. Who is taken this? The firm or business or any that individual undertake a business or anything. It create or it produce cost or benefit to third party or any other person. That is known as externalities. From the word you got some idea, external. External to a particular person. That's a person started their business or he started a firm. It creates some benefit or cost to other person. That is, in the case of third party, he does not take any monetary transaction here. That is, monetary payment or monetary transactions are undertaken by this particular example. A is a person. He started a firm. It creates some benefit. Not only the person, that is the benefited party, not only the particular person A, at the same time, some indirect benefit enjoyed by the person B without price. Without price or without payment. That is known as externalities. External benefit or external cost incurred here. Any person undertake any activity or any activity, it creates some benefit to other individual, that is, or firms, individual or firms, in addition to the benefit accruing to the emitting party. Or that is another definition is that it refers to the cost incurred or the benefit received to a third party. That is, it refers to a cost incurred or benefit received by a third party. Such a party does not control generation of cost or benefit. He does not control the cost or benefit, because the cost and benefit arise from a particular person. A person started a business or started a firm, that it produces benefit not only a particular person but also the benefit enjoyed by or the cost incurred for another person. That is known as externality. So it considered this is based on one of the important condition of market failure. Externality is one of the important feature of market failure. Market failure shows that does not work according to the condition of market, like that's market mechanism like demand and supply. Demand and supply conditions is not satisfied in the case, that's known as market failure. So one of the important characteristics here, externality, that's one of the important feature of market failure. So it is non-excludable plus unpriced. The characteristics of externality show that this is non-excludable and unpriced. Unpriced means not based on the pricing system. Non-excludable means it is included. Included means all are getting the benefit. Without payment. Without payment or without price, other person enjoyed the benefit or cost, that enjoy the benefit or cost incurred, that is equal to externalities. That is, it refers to the cost incurred or benefit received by a third party. That is, this third party does not control generation of cost or benefit, or he does not mind the price or payment. That's one particular person started a business or firm. He enjoyed the benefit, at the same time indirect benefit enjoyed by other person, or here there is a indirect cost incurred for other person, that is equal to externality. So that is a definition of externality. Externality mainly arises from the production of goods, that is production of goods and services. That it mainly arises from the production of goods or services. It mainly arises from the production of goods and services, or production of goods or services. Allengil, it refers to the production or consumption of goods or services. In the case of externality, mainly arises from the production or consumption of goods or services. Then it affects not only within the organization, at the same time that is the entire society. It affects within the organization and entire society. These are some of the speciality of externalities. Externality shows that external benefit or external cost incurred. Any activity undertaken by an individual or firm, that it creates some or it produces some external benefit or benefit to other person, or cost, that is benefit received to a third party or cost incurred for a third party, that is equal to externalities. Externalities arise from the production or consumption of goods and services. Then it affects within the organization and the entire society. That entire society may affect because of the existence of externality. Externality, one of the important characteristics of market failure. That market failure shows that wherever demand and supply not satisfied, wherever market mechanism not applied, that is the important feature of market failure. In the case of one of the important market feature of market failure is the entry or appearance of the externalities. Next, externality mainly classified into two. It mainly classified into two. One is that positive externality and other is that negative externality. Externality mainly classified into two. One is that positive externality and second is that negative externality. Positive externality shows that any activity undertaken by an individual or firm, how much benefit received to a third party or other person, that is equal to positive externality. Any activity undertaken by an individual or firm, the benefit received by a third party, that is benefit received by a third person or third party, that is equal to positive externality. And in the case of negative externality shows that when an activity undertaken by an individual or firm, that how much cost incurred to a third party, that's the cost incurred for a third party or the cost incurred of a third person, that is equal to, here there is a negative externality. Because of any activity undertaken by an individual, cost incurred to a third person or third party, that is equal to negative externality. Benefit received to a third party, that is equal to positive externality. That's any firm started a business, so this business does not only benefit to a such person or that particular person, but the benefit also received to other person. is known as positive externality. Negative externality shows that any activity that is undertaken by a firm or individual, it produces negative impact on others. One is the positive impact on others, and next is that negative impact on others, that is equal to negative externality. In the case of best example for positive externality, because of education, educated person does not only benefit to a particular person but also benefit to the entire society. Thus, educated person not only benefit to a particular person but also that benefit to the entire society. That is the best example for positive externality. In the same way, if planting trees, that person's property look nice and at the same time it clean our surrounding area. That is, if you planting trees, it not only that property look so nice, at the same time clean our surrounding area. That's the best example for the positive externality. Negative externality shows that any business started by an individual, it created pollution. So, it created the pollution, that is equal to negative externality. At the same time, this pollution not only does adversely affect the surrounding area, at the same time harmful to others also. Adversely affect or polluted the environment or at the same surrounding area. At the same time, this adversely affect or harmful to the individual. So, in order to avoid the harmful to the person or individual, that's the cost spent by, that is cost incurred here. That is known as negative externality. Any activity undertaken by the individual, example a firm or business started by an individual, it polluted the air. So, pollute the air, this may adversely affect the surrounding area's population. So, thus it is harmful to individual or harmful to the society. Such is known as negative externality. Any positive externality shows that education. Because of education, this is not only benefit to such a person or particular person but also benefit to the society. These are the two examples for the positive and negative externality. So, start that. What are the important causes of externalities? There are two important causes here. One is that poorly defined property rights, and second is that presence of transaction cost. These are the two important causes for the emergence of, that is, externality. One is that poorly defined property rights. If the property rights not clearly defined, so here there is a problem of externality here. Yes, allocative efficiency is not possible or market mechanism is not possible. That is known as, that market failure is one of the important characteristics that externality. So, market failure or market mechanism is not here because here there is a property rights is not clearly defined. Yes, which person property is this? So, that person's property clearly defined here. If the absence of clear definition about property right, it may create the emergence of externality. Absence of clearly defined property right. And second is that presence of transaction cost. Transaction cost is that here there is a, that's economic market. That is in the case of the transaction, here there is a exchange. Existence of the exchange cost. That is another important reasons for the externalities. Here there is a external cost, that's transaction cost that's present here. It may create the externality. These are the two important costs. The presence of transaction cost or exchange or market cost, and second is that here there is a property right absence on. Here there is a clear definition about the property right. These are the two important causes here. To solve this externality, there are some of the solution or some of the important measures to overcome the problem of externality. Externality shows that here there is a allocative efficiency is not possible. If that is, here there is a market failure. No market mechanism not based on the according to the demand and supply. So allocating efficiency is not possible. That is known as non-excludable. It guided the principle of non-excludable, so that all are included without considering the pricing system or payment. At the same time, unpriced, not based on pricing system. So that's an important characteristic of the externality. To solve the externality or market become more efficient or efficiency in the allocation of resources, there are some suggestions here. One is that regulation to limit activity that might cause negative externality. Yes. If you control the regulation to limit the activity might cause, here there is a negative externality. Yes. If there is a controlling system, yes, it may controlling system. Here there is a negative externality because of the existence of regulation. Regulation to limit activity that might cause the negative externality. So regulation is the one of the important point. So regulation may limit the activity. If you control the activity, it creates negative externality. The first important solution. So to become more free, yes, regulation is the important cause for negative externality. To become more liberalized or more freedom in economic activity, it creates positive or to become more efficiency. And second is that taxes may reduce the economic injustice or imbalance. If there is a negative externality present here, this overcome with the help of taxation or subsidies. Because of the existence of taxation, it can overcome the negative externality. So here there is a possibility of negative externality. This is priced with the help of taxing system introduced by the government. So it can overcome the problem of cost incurred here. So cost incurred, that's any firm undertaken, that's any individual or any firm undertaken a business, if it created pollution, so that cost incurred here overcome with the help of taxation. Taxation is the best measure to overcome negative externality. And third is that government provision of services with positive externality. Government supplied the services only with benefit or positive externality. Government does not mind the negative externality. Provision of goods only with the positive externality. And next point is that corporation or partnership will allow confidential sharing of information among the members. If there is confidential sharing among the members, that in the case of it allow between the corporation or partnership. Corporation or partnership, they may allow the information among the members. That this information which may be highly confidential. Confidential sharing information among the members, that is between the corporation or partnership. That is information, it may be correct. Sharing of information, it will be highly confidential or highly informative. So this can avoid the problem of externality here. And lastly, that in a planned economy, production is typically limited only to the necessity. Production is only limited to necessity, which would be eliminate externality created overproduction. So it solves the problem of overproduction here. That is, in a planned economy, this is in the case of planned economy, according to the decision of the government. That is not planned economy. In a planned economy, production is typically limited only to the necessities. Limited to the necessity, which will eliminate externality of overproduction. Eliminate the overproduction. These are the main important solution here.